Hello everyone, today I want to talk about the butterfly strategy, or more specifically, the butterfly with different wings. This strategy is a reverse butterfly, which is used to capture a strong up or down move. Today I want to demonstrate the opportunities that the inverse butterfly offers. Right now, as we can see, cryptocurrency is in a very flat state, in a narrow channel. Volatility levels are very low, unnaturally low. And a reverse butterfly strategy can be useful in a current moment when we are waiting for an up or down move. First, we'll just look at the regular inverse butterfly. I'll start by opening the options board for Bitcoin. I'll take the closest series. You can build a butterfly with put options and call options. I covered all of this in details in the previous lessons dedicated to butterfly. Now the price is around 29,700 and I take the center strike of the 29,500 option. Let it be a put option. To do this, I buy 2,000 contracts at the central strike, 29,500. And at each of the edges, I sell 1,000 contracts. The number of options sold should be equal to number of options bought. So take a look at this strategy right here. It has the same wings at the same height. Now let's assume that we want to sell not 1,000 options, but 1,300 options at strike 29. At strike 30, we sell not 1,000 options, but 700 options. Now let's do better. 800 options at strike 30, 1,020 options at strike 29. We end up with a very interesting construction. It's a reverse butterfly with different wings. Its right wing is lower than its left wing. What does that mean? It means that we have a no-loss zone on the right. We make nothing and lose nothing if the Bitcoin price goes up. But if the Bitcoin price falls, our no-loss point is somewhere around 29,100, we make a profit. The price should fall on the upper wing of the butterfly. So how do we get the right different-winged butterfly? We must remember a simple rule. The number of bought options in the center of the butterfly should be equal to the number of sold options on the wings of the butterfly. Let me remind you, I bought 2,000 contracts at strike 29,500, sold 1,200 contracts of strike 29, and 800 contracts of strike 30. I sold as many as I bought. My strategy is built on an expectation that the price will go down, but we can do the opposite. We can sell a smaller quantity on the left, 800, and a larger quantity on the right, 1,200. And then the butterfly will change wings. We can compensate for the quantity on the right, sell not 1,200, but 1,150, and sell 850 on the left. Thus, we get a no-loss zone on the left at any price drop below the strike. But if the price rises, we'll make a profit here. The conditions are good. The margin requirements are $57, and the potential profit is $146. What risks do butterfly strategies have? Upside-down butterflies have the risk of being in this pit here, with the big time decay. The key is to clearly understand the risk you're willing to take in this strategy, and if you suddenly reach the risk zone, close the strategy, lock in the risk, and do not allow the price to be at the strike of the options you bought. As the expiration date approaches, the time decay accelerates greatly. You can take a serious loss. Okay, let's look at the another case. Suppose we expect a strong growth for Bitcoin. ETFs for large investing companies will be approved, and there will be a strong growth. I buy 2,000 contracts of call option strike 30,500. Now I sell 1,100 contracts at strike 31 and sell 900 options of strike 30,000. Or no, I change my mind. Minus 800 and minus 1,200. Take a look at the finished strategy. In this strategy, I expect the price will not rise above 30k, and that there will be major news and events related to ETF approval for large companies. In this case, the price will exceed the 30 mark and will easily pass the 31 mark. This is where I have a profit zone. Starting at 30,800 and after 31, I go into full profit. If the price stays where it is or falls, I get minimal profit, participation price. The most important thing is that I don't expect the price to be in this range, 30,500 at the strike of the purchased option. The most important thing for me is to limit the risks. I am ready to limit my risk up to $25. But if the price rises, my profit will be $227. If the price does not rise, my cancellation price is a profit of $27. Such strategies can be used with both up and down movements. And at this point, the peak of purchased options is best place where you least expect the price to be. Homework. Build an asymmetrical butterfly in the terminal with call options, with a strike of 31 for example, and no loss zone on the left side. Task number 2. Buy put options at strike 28,500 and build a butterfly with a no loss zone on the right side. This is a strategy directed on a down movement. And after that, you will be able to build similar strategies in real market conditions and make money on it. If this video was helpful to you, please give it a like. Leave your question in the comments below the video. Suggest your topics for lessons. Subscribe to the channel if you are not already subscribed. I wish you all the best and successful options trading.